Greetings everyone and good evening. Welcome to the Thursday evening Viper Trading webinar. If you're here to learn about trading the financial markets using the Viper tools, you're absolutely in the right place. First, we got to knock our standard disclaimer out of the way. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar or other webinars, including the live trading room, are to be construed as investment or trading advice. Of course, everyone here does know that you do trade at your own sole discretion. Welcome, everybody. If you're just coming in, we're just getting started. You haven't missed anything yet. I'm going to come over. I'm going to start with. I'm going to start kind of slow. I'm going to do a brief recap of the basics, mainly because we have a lot of folks who are visiting us tonight, and so this is going to be kind of new to you. So I want to kind of make sure we're all on the same page before we get rolling down the road here on trade setups. So without further ado, come over here to screen one. So here's what you're looking at. This is NASDAQ today. This is NQ. We trade this in the room. This is one of the Maurizio, ciao Bella. Glad to see you can make it, my friend. One of the things that adds just a little bit of clutter to the chart is these predictor ovals. It's very easy to toggle those on and off. Just simply hide predictor. Click on this button right here and it will take them off your chart. So if you like something kind of what you see in the room without a lot of clutter, that's how you would do it. So most of you know, of course, I'm here in California, so everything you see here is Pacific time. This would have been midnight Pacific time right here going into this morning. And the first handful of hours there, of course, is the European session. So you do get some movement overnight with the folks over in Europe and other parts of the world trading. This is the Asian session right now, between now and midnight Pacific. And so you can see what I'm just going to recap. Of course, the Viper indicators, everybody knows, is on this chart are the background colors. Green, yellow, and this sort of transitional color. The bar colors, blue, red, and yellow. Some of that has meaning. Obviously, we'll talk about tonight. We have this notion of the bands right here. Mid band is the large, thick band right here in the middle, called the mid band, of course. And we like to watch that for various reasons. And then you have 4 bands above and 4 below. One of the more prominent indicators on the chart, of course. Then we have the swings. You have the stealth line here, which is this little sort of line right here. I've had that forever. And so when you look at financial markets, if you go back and look at how markets work in general, is that you go through periods where a market will be trending, and then you go through markets or times in markets where markets are not trending. And so it's very important that at any given point in the trading session, if you're actively trading, whether it's in sim or real money, it's extremely important to know what type of market you're in. Let's look at different types of markets and talk about this, because it drives everything in terms of your decision making on where you're going to get in and out of trades and whether you're going to trade it at all. Okay. So the first thing we have, looking to the left of this chart here, is we have several different periods where markets oscillate in a consolidative range. This is called sideways price action. You can see several of them here, and they take on different forms. Some of them are a little larger, like this. Some of them are a little smaller, like this. Okay. Now, many traders don't like to trade ranges. Show of hands, how many of you like to trade ranges? How many don't like to trade ranges? Just type in a Y for yes, I like to trade them, N for no, I don't like to trade them. Ranges, like you see here, these 2 blocks right here. What a mix. Diane starts off saying, I love those ranges, and then everybody else is a big no. Wow, that's ironic, Diane. Most traders that I've known over the years don't like ranges and they love trends. You're kind of on the reverse side of things. You like the ranges and you struggle with the trends. Interesting. Here's an interesting answer from Dennis. Dennis says, occasionally I'll like the, excuse me, trading the range, but it depends on the type of range. Okay. So here's a rule of thumb. Okay, here's a rule of thumb is that if the range is at least, at a minimum 20 to 25 ticks in size, we consider that to be a tradable range. Let's take a look at the range on the left. Bottom looks to be around this 45, 44 kind of swing down here. And the top comes up to be around 70 or 52-ish. So is this range tradable, yes or no? Bottom's at 45, top's at 52. Based on our criteria, is that a tradable range, yes or no? I'm going to cover a lot of material tonight, so I'm going to move pretty quickly. When I ask these questions, I'm only going to give you 10 seconds to respond, because that's how quick we need everybody to get up to speed, so that when you see things on charts, you just subconsciously, you don't even have to really think about it. You know what the answer is. You know what to do. Barely. Yeah. All right, that's 7 points, and we all know that NASDAQ is 4 ticks a point, so that's roughly 28 ticks, plus or minus, say 25 to 30 ticks from the top, from the bottom of the range to the top. So yeah, that would be tradable. How about this one over here? How about this range right here? How about this one right here, where the bottom's at 33, roughly, and the top is up here around 36-ish. So is this one tradable? Right here. Arguably, it's a range. It's hovering right around the midband. 3-point range times 4, 12. Probably not. Only for non-Viper traders. There you go, Walter. It's too tight. Yeah, it's a little too tight. And just talking about entries and exits, and the reason for that is, and most of you, of course, know this, but I'll go ahead and sort of state the obvious, that when you enter range trades like this, that you have to fade the bottom with your entries or exits. Fading means that you see an identified swing level down here. In fact, let me just go ahead and put it in. Let me just go ahead and draw a line there real quick. Oops, there we go. Let's just finish out our discussion about ranges real quick here. All right, so support's down in here, right? Let me make this line a little thicker here. Yeah. So you hear this term a lot in the room. You hear this bantered about quite a bit, fade that area. And so what fade that area means is that in order to buy or sell an area, a support area, let's suppose that your entry was going to be to buy support. Well, you know that you can't put your buy order right on that line, because you're probably not going to get filled. So you fade it. You got to come at least a couple of 5 ticks above there, so you're actually getting filled somewhere in there where that blue line is. And you can see also that resistance is up in here, and to get in there or out, you have to fade that too. So your sell level, if you're buying support, is up near the top of the range. To get out, if you're buying support. So if you think about it, your actual profit in the trade, let's say hypothetically you're buying the bottom of this range and you're getting out, you're fading the top, right? You're getting out somewhere in here, because here it just went a little bit above it, here you went above it, here you went way above it, and here you just touched it. Likewise, if you are shorting the top of the range and taking profits at the bottom, in other words, you're trading both sides of the range, right? You're shorting here as resistance, and so the trades might look something like this. Maybe you caught this short, maybe you didn't. You have a short here. You have a long trade here. Another short here. You get the idea. I'm probably not going to do all of them. You get the idea. You see them, right? right? You got long here, kind of came down. Maybe you stopped up, maybe you re-entered. You didn't quite get back up to the top, and then you had another long here. I should actually draw it more in between these lines. So you can see that, if you applied that same entry and exit logic to the tight range with the whole notion, the concept of fading, you're fading this top here to get in or out, right? And you're fading the bottom down here. By the time you have a little bit of slippage and commission to get in and out, is there any meat in the middle of here for you to make money on a trade? There's nothing left. There's nothing left in the middle there. You'd be just churning contracts, paying your broker. That makes sense? All right, so the other factors before we move on from range trading is that there's a couple other things to factor in. How clean and clear the support and resistance levels are. I'm going to show some other ones that aren't so clean and clear. In other words, if you get these huge spikes up and it goes way up here and it huge spikes down, huge spikes up, huge spikes down, and you can't really see very clearly where the top and bottom is, it's probably going to be a range you're not going to want to trade, even if it qualifies under the 25 tick rule, right? Because it's not very clear where to get in and out. If all these tops and bottoms are kind of syncing up with each other, it's real clear where to get in and out, this is a good tradable range right here, this one. Could have popped a couple of good trades, 3-4 trades out of that area right there. All right, so last question before we leave this range. In your view, pulling the team here again tonight, your primary mode of entry, would it be to buy the bottoms? So that would be an answer of a B, right? Or would you be shorting the top? That would be S. So you'd be shorting the tops, covering at the bottom, shorting the tops, covering at the bottom. Or B, or both. So it's B for buy, you're buying the bottom, taking profits at the top. In other words, you're only buying, you're only taking longs here. S, you're only shorting the top, and then you cover down here, you're not buying it. And how many of you, if you traded that range, would be trading both sides? Both. B, S, or both. And then we're going to leave this range right here. B, S, or both. While you're typing your answers in there, I see quite a few good answers coming in on that question. Let's take a look at how much meat is kind of left in the middle of the range for you. So let's say you're getting filled around 46.25-ish on your fills down here, and you're getting out at 51. So what is that? 46.25 to 51, 46, 51, 5, 19 ticks. Somewhere between 17 and 19 ticks in the middle here. So the overall range was like 28 to 30 ticks, and you're getting about half of it in the middle. Okay, interesting. Let's see what the feedback is on the approach to trading the range. Wow, quite a few would stand down. We have quite a few boths. Dennis and Jim both. Carl G would stand down. And then we have an even mix. Dave H, Michael P on the buying side, Richard C, Peter, and Mac on the shorting side. So here's the deal. If you have a range that sets up after it has come out of a move, and let me show you a little bit about that right here. Okay, let's come over here and look at this. Over here, the trend was up, and we come back into sort of the range that we were in back here in the overnight session, right? Well, obviously, it's starting to get into a little bit of a range there, but in the case of this, where we have a green background and the trend is up, we are buying support as long as it holds that support level, right? So there's this region box at the mid-band would have been a buy. If you are coming off of an uptrend, generally speaking, you're going to want to be buying support as your primary mode of entry, because there is some likelihood that the trend would continue to the upside. Likewise, if you're generally coming off of a short trend and you're consolidating at the bottom of the trend, we're going to look at that. That happened today. We're actually going to, in a few minutes, we're going to look at this morning, and I'm going to show you that. Let's go back and look at another quick area where I can briefly show you what I'm talking about. So what we're discussing now, just for you, I see some people coming in late. What we're looking at now is we're looking at various types of ranges we're looking at NASDAQ, but the concept that we're talking about here applies to pretty much universally any instrument, because these patterns set up on every instrument. Doesn't matter, crude oil, gold, it really doesn't matter what you're trading. The price patterns are all pretty much the same. The only difference is that some instruments do not respect their swings as well as others. So this is where you have to experiment with different instruments to find one you like. Here's a good example where you could make the case, this would have been late in the morning yesterday, that while the overall prevailing trend from say about late, say about 10:15 yesterday morning all the way over here until the close, you could make the case that you were kind of trending up a little bit, yes? The overall market was, it wasn't obviously very pretty how it was doing it, because it was kind of chunky the way it did it with fits and spurts. But my point I'm trying to make here is that punctuated within the overall context of the market moving up, you had short periods where you were range bound, yes? Here's a range here, here's a range over here, here's another range here, and then you have other ranges setting up over here. So the point I'm trying to make here is that if you're in somewhat of a trending channel punctuated by short periods of consolidation ranges like this and like this box and like over here, what's your primary mode of entry in a condition like this for each of these ranges? Are you buying B? Are you selling S? Or are now you trading both sides of these boxes? Should you choose to, for those of you who are not standing down, obviously. So for this type of condition, if you saw this tomorrow morning and you were trading and it looked like this, and you decided to trade these ranges in each one of these boxes here, would you primarily be entering to buy the bottoms, take profit at the tops, sell short the tops of ranges, cover at the bottom, or both? All right, we got a good mix coming in here. Couple of boths. The prevailing answer that's coming in, Michael P. Richard C. here, all the way down, buying from the bottom supports. Good. Yeah, that's the point I'm trying to make here, is that if the prevailing trend is up, even though it's punctuated with brief periods of sideways price action, your primary mode of entry is to buy the support. When it comes back into support, you're a buyer down here. Now, with NASDAQ at $5 a tick, if you have sufficient capital and risk capital in your trading account, we suggest that you try to take at least 2. No boat loading, right? Yeah. You're obviously not getting big runs here, and so let me speak to that for a second, because there's a whole, we always talk about getting in, but let's talk about getting out, because there's been several questions about this whole notion of scalping and when you should take scalp trades. The way that works is this: is when you have a clearly defined swing up here, you're going to want to, you're going to want to take some profits on that on your first contract. That's a given. That's called your scalp trade. Generally, that's going to be in the 6 to 8 to 10, 12 tick sort of range. That's sort of the sweet spot of scalping. Once you do that, when you enter, of course, your initial stop, which Object Trader puts in for you, would be 12 ticks below your entry. So let's suppose you're getting filled long on this, in the case of this little range right here, you're getting filled long, I don't know, somewhere right in here. You're fading that bottom, right? Well, you go 10 or 12 ticks below that, depending on your setting, and here's your stop, your initial stop. Once you pop up and get that scalper target, you get up there quick, you're going to want to make sure that this trailing stop, and Object Trader you can automate to do this, by the way. It'll do it automatically for you. You want to get within 2 ticks of your entry. Okay? And then you can have Object Trader, you can actually follow it up and put tighter stops. You don't have to just let it sit down there and take all your money back. In the case of a range, you might want to just get out of both. Now, what happens over here? And this is part of the reason you want to have at least 2, is to the very right of this particular range here, we not only got our popper scalper right here, came up, and then it took it out. So the question is this: what do you do with that second contract? Right here. What do you do with the second contract? You already took one off here. You got one left. What are you going to do with it? Why do we have that second one? Why put on two? You're just doubling your risk. You take a big loss, you get a hit on two. Why would you want to do that? It seems more risky to me. Good, MG Mac. The second one is the runner. Good. So you can trail the stop, Peter W. Absolutely. Carl G. It's a bonus runner. You manage the trade, trail your stop. So in the case here, of course, here was our initial stop below our entry. You can manually do this, or you can have Object Trader do it. Okay, you pop up, you get this target here at the top of the range. So one is peeled off for you, right here, right? Just like the other trades. This one, this is the third one. Your initial stop pops up to a couple of ticks below your entry. Well, now you've taken that swing out, okay? So now you're going to start managing your runner. You're going to start trailing your stop up, trailing your stop up, trailing up. Depending on how tightly you manage your stops, the second contract got taken out here. Similar condition happened over here in the right-hand side of this range box here. Here you got long. Well, let me pause for a second. Here you had your target for your scalper at the top there, and then of course here's your runner right here. So now you can see why the primary focus in the case of an uptrending market, even though it's, as I said earlier, it's punctuated with these short periods of consolidation, your primary mode of entry is to buy. You're getting in and you're taking profits. You're not generally shorting up here. You would not trade both sides in a condition like you see right here. Because what's going to happen is we are expecting trend continuation. And when you get that, you get these follow-on runner trades like you see there and like you see there and like you see over here. So in the end, I think we all see that these little ranges that form don't need to be scary, and they don't really need to be something that you try to avoid. It's really a skill set that you should add to your repertoire of trading and sort of, sprinkle some range trading in with your other types of trade entries that you like. I know several people have told Gary and I that they just like to do the mid-band trades. They want to see a trend, they want to see a region band at the mid-band, and that's your go-to trade. And that's perfectly fine. If you watch a couple of charts, you're certainly going to get at least a couple of those in a morning. And if you work to perfect that, that can put some very nice coin in your pocket. What we're saying here, though, is that if you can expand outside of that comfort zone, try experimenting with trading some ranges. And in the beginning, as you start to trade these little patches here, maybe the thing to do is don't try to trade both sides when you first go after trying to learn how to do it, right? Maybe you just, in the beginning, if it's an uptrend like this, just try the buy side of it and try the scalper side, right? Try the buy side, try the scalper side. Put two on, see if you can catch a little runner. Practice doing that. And practice doing that on maybe 2 or 3 different instruments. And with the idea that eventually you narrow it down to one that's pretty much kind of your go-to, and you should always have a second chart with another one as your backup. That's why I like to focus on, most of you know, you've seen it in the room, I focus on NASDAQ, I focus on YM. I heavily trade those early in the morning. I also keep a crude oil chart tucked off. I got 4 big screens here. Got crude oil tucked on the side. If I see a nice juicy crude trade set up, I'll go ahead and take that, of course, too. But that would max out. I wouldn't, I know we have 4 in the room. If you can, you want to keep your charts minimalistic as you're starting off and learning. 1 or 2 charts max. I wouldn't, in the beginning, I really would suggest not putting 3 and certainly not 4. Because here's what happens. I'm not going to put them all on here, but I'll just give you kind of an idea how this goes, right? Here you got a NASDAQ chart. Here you got a YM chart, and maybe you got a crude oil or some other thing stuck over here somewhere. Well, you know, you're kind of watching NASDAQ, and you're kind of watching here, and this is running a little counter from that one, so you're a little confused on whether to get long or short. And you're watching something over here. It really doesn't set up. Next thing you know, over here, a beautiful NASDAQ trade set up. It took off its run, and you could have scalped and got a runner, made some money, but you're dinking around over here, and you wind up missing both trade setups. How many has that happened to you in here tonight? How many has that happened to any of you in here tonight? What I'm describing there, that whole 2 or 3 chart, and you're distracted, and you all of a sudden in the room you hear a call on oil. Oh wait, man, I should get an oil chart up. You get the oil chart up, you come back to that. Oh darn, look at that, YM had a run. I just missed it. And then you want to chase it and you can't, and it retraces and you don't get in. That happens to me all the time. Okay, all right, well, I won't disclose names. It happens all the time, sure. So what we have to do is we have to change our behavior, right? We don't want to keep doing the same thing over and over again and expecting different results. Here's a good feedback from Walter. Walter, I got to give him super credit because he comes to every webinar and he is in that room all the time taking trades. And many, many mornings he's done like in the first half an hour. 1 or 2, 3 and done. And he says this, I used to have a lot of charts up. I don't do that anymore. Now I focus on just 1 or 2. So in the beginning, as you're learning, you should give yourself a chance to learn different instruments. So I'm not saying in the beginning to be so restrictive that you don't try different things. You got to really learn the system. You got to learn the instruments, right? Instrument selection is key. But then through that eliminative process, you're going to work yourself down to where you just have 1 or 2. And those are the ones that you like, and those are the ones you get really, really good at, right? Last thing I'm going to say about this, where most of the money is made in trading futures is in leverage. Okay? Leverage. What I mean by that is that you might say, well, you know, Charles, NASDAQ's only $5. I can't make any money $5 a tick. I don't care if the thing ran, you know, 40 ticks. That's only a couple $100. There's no money in there. Well, what if you put 20 contracts on it? Could you make some money then? With that run right there with 20 contracts? By the way, that's normally what I trade. I normally put 20 contracts on it. Okay? So that's the leverage up. It takes time to get to that point. You know, I've been trading 20 years, so it takes, you're just not going to trade 20 contracts tomorrow. It takes time to work your way up. But if you don't focus on the money, the key thing is to focus on the entries. Focus on the entries. And if you can find yourself to get good entries, just really nail the entries, manage your trade properly, find 1 or 2 good instruments that you get really, really, really good at, become an expert in them, and then at that point you start to leverage up. You can go to 2 contracts, 3, work your way up, right? Now any questions on this? Any questions on how we approach you know, markets that channel up, punctuated with some little ranges that are just kind of ranges with no trend associated with them, which would be this one we looked at earlier here. So you're just flat sideways. There's no real trend here per se. All right. All right, let's skip over to today and let's start looking at working on anticipating trade setups together as a team here tonight. Based on everything I've shown, I'm going to show you some things, and I'm going to give everyone in here 10 seconds to respond. I'm going to start easy. David, it's really a function, you know, I get that question all the time. I get the question of how long is it going to take for me to get to the point where I'm leveraging up? It's a function of many things. The most important, of course, being how much time you have to devote to trading. You know, I trade full-time for a living, so I'm looking at charts all day long and all night long. I'm looking at charts. But 20 years of looking, I probably have 10,000 hours of looking at charts. I don't even know, it's some ridiculous number. I'm just making a number up. But what that does for me is that when I see certain things happening on a chart, I don't most of the time, and I'm not trying to be braggadocious here or anything. I'm just trying to say that I've seen it so many times that it's almost like second nature. I just see it and I kind of have a pretty good sense of what's going to happen. So it makes it a lot easier. So if you have the ability to look at charts and really study charts and become a master of price action, and it's also a function of how quickly you can ramp up and learn. If you can pick the stuff up pretty quickly, yeah, it becomes instinctive. I think that's the best way to put it, Walter. Yeah, you want to get it to a point where, here, let me show a chart here. I'll show you what I'm talking about. All right. Now, you can see here that we were pretty much, this is today. The open of the equity markets was 6:30 Pacific, which was right here. All right, let me clean this chart off here real quick so we can have a nice clean chart. Take all the drawing tools off here. Yeah, there we go. Clean chart. So 6:30 was right about here, So the equity market opened right here. Let me put a line right there. All right, so going into 6:30, was NASDAQ in a trend, yes or no? And if it was in a trend, what was the trend? I have an array, Adam, on the 4 monitors. I have those big post stands, so it's an array. It's like if you put one on top of the other and then the 2 next to it, with those post stand things that bolt into the back of the monitors. So we're looking over here. We're looking to the right-hand side of the chart. Is the market in a trend, and if so, what is it? Over here. Here's the open, 6:30. Here's news. We had news at 5:30. That would have been over here. Anybody remember what the news was today? What was the news this morning? I'm see if anybody remembers. It was a critical. I don't focus a whole lot on news per se in terms of exactly what the numbers or tracking the numbers, because that can be a little misleading sometimes. But I am aware when there's major news. Philly Fed. Good. Unemployment numbers. How'd those numbers look? Let's take a look. Right here. 5:30 a.m. pre-market. High impact expected. How'd that number turn out? Not so good. Really bearish. Market didn't like that at all. So what happened at 5:30? Market started selling off. How do we know? Well, first of all, you can see the support level in this prior range got taken out right here, right? See it? See it? At 5:30 when that news came out, we blast through it, and then we go through a series of lower highs too, right? See it? The market was in a downtrend at the open. It was reacting to the bad Philly Fed news, and it was trending down. We were looking for shorts, right? Each one of these mid-band kisses is a short trade, just to let you know, right? There's a short right there. I'm not going to do them all. I'll do a couple of them, right? Here's another one right here. There's a short right there. There's another one right there. Another one right there. There's 4 of them right there. 4 shorts. Background characteristics of a downtrend are as follows. The background is red. The bands and the mid-band are stair-stepping down, like such. You're getting a series of lower highs and lower lows. Generally speaking, the bars are primarily going to be red in color. And so visually you can see that, yeah, I mean, I see what some of you are saying. Some of you are saying, well, arguably, Charles, you're kind of in a little bit of a channel here, right? Some of you said sideways. I understand that. Even though it's sideways here, could you have been trading it? And if the answer is yes, you could be trading it, then what were you doing? Shorting resistance. Right, shorting resistance. Good. Now, one last word about this, okay? When you trade trends, and Diane, this is obviously for you, since you still struggle with trends a little bit, is the main thing that you want to remember. There's 2 things to remember in a trend. First of all, We never, ever, ever buy or sell the thrust move in the direction of the trend. What does that mean? Here's what we call a thrust move. So in other words, we came back up, we checked the mid-band, we found resistance. Somehow we used our tools, we entered the trade short, and we get a thrust in the trend continuation down move, which is the thrust. Many of you, I know, are compelled to get into trades after the thrust move is made. So what's happening is you're shorting down in here. By now you're convinced. You're convinced that the market's dropping and it's time to short it, and you pull the trigger down here, only to feel the pain of the retracement back in your face, which is probably going to go up and get your stops right up here. Anybody still doing that? Here's how that happens. It happens, I know, it happens. You come up, you might see that rollover, maybe you don't. It starts to drop. You're really not convinced that it's dropping yet. It gets down and it takes this swing high, and it gets down to there. By the time it gets down there, you're like, man, this thing is falling off the map. It's time for me to pull the trigger and get in. I better get in. So you hit market short down here and you get filled. I don't know, 29.50. So it goes a couple of 3-4 ticks in your favor, and you're feeling pretty good. You're feeling pretty good down here. It's going to just another 100 ticks straight down, right? Your stop's right up here at 12 ticks. Well, then it starts to pull against you. It starts to pull against you. It comes all the way up here, and no matter how tight or loose your stops were, it comes up and it takes your stops out. MG Mac, is that your big problem? So here's what we need to do. We need to always, 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 in a trend, only trade the retracements. Never, ever, ever do we want to buy or sell thrust moves. The thrust moves are the end where people who were short from higher levels are taking profits. What happens is that you get in at these levels, you get stopped out, and then I always hear things like this. The classic statement is, I'll tell you what, the market always knows when I'm getting in a trade because it always moves against me. Why does it do that? Why does it always move against me when the market knows I'm getting in? Well, no. That could be, but in all likelihood, probably not. These markets trade tens of thousands of contracts an hour. So 1 or 2 contracts probably aren't catching anybody's attention, first of all. And second of all, you're picking, all due respect, you're picking the wrong spots to get in. We need to get in the retracements, where the markets pull back in a downtrend to resistance, and they roll over, and that's where we get in. MG Mac, that's how you fix that, okay? Whenever you see a thrust move, remember the thrust move is where shorties or people who are long are taking profits. You got to sit on your hands if you're not in the trade. You got to wait for that retracement. That goes for everybody. All right, now let's advance this chart a little bit, and then you're going to say where to get in the next trade. Ready? 10 seconds on the clock. Learning every day with Viper. Okay, that's good. That's what we want to do. That's why we do so much teaching with the webinars, even in the live room. We want everybody to learn the system and make money every single day. All right, how many of you are ready to short this market right here? I think it's time to get in. I would pull the trigger right here. See that bar right there? Market short. Anybody taking it up with me? Right here. I'm getting short. If I had my OT up here, I'd be hitting market short right here. Sell right down right there. Probably look for a good fill would be like 27.25. 26.50. Trend is down. We're selling, right? We're shorting. I know there's a red background, red bars, stair stepping down. All the criteria are for shorts, so it's time to short it. No, says Walter. Okay, good. Buying the thrust, that is the first semester's tuition. Carl, that's a good way to put it. Yeah. Yeah. Many years ago, as I was learning that painful lesson, contributing to the broker loser gods, if you will, by buying and selling thrusts and always getting stopped out. All right, yeah, no, this is what I'm saying. We're obviously in the thrust part of the move. Many of you typed in the entry was up here at 639. Perfect. Yes. No. This is the thrust part of the move in a downtrend. We just said it, right? You don't buy or sell thrust moves. You got to wait for retracement. So where might this market thrust to get short? We're looking for a level here, somewhere on the right. This is the whole anticipating the trade entry part of our discussion tonight. So here's the thing, while you're typing that in, I'll give you 15 seconds because it might take a little more time to spot it. 15 seconds for you to call out a trade entry area. What was I saying? Oh yeah, so we're looking for short. So it's obviously a short, and you're looking for a short area to anticipate. Oh, this is what I was going to say. I was going to say this. When we say the word anticipate trade entries, and there seems to be a little confusion around this, we're not, sort of looking into a crystal ball and saying, okay, I see the NASDAQ is going to go right to here, and that's where I'm going to get short. That's not, when we say anticipating trade, that's not what we're doing. What we're trying to do is this, is let's face it, as I see some great answers coming in, by the way. Please continue to answer. We still got 10 seconds to answer. Where your short trade entry, looking ahead on this chart on the right-hand side, where are you looking to get short over here? Right in here. Where? A number, area, however you want to phrase it. I mean, let's face it. So whenever you pull the trigger on a trade, any trade, what are the odds of you having a winning or losing trade? What are the odds? Any trade. What's the odds? 50-50. Right? Well, let me ask you this question. If the odds are really 50-50, then how are you going to make any money? How does anybody trading make any money if the odds are 50-50? How is that possible? How is it possible that you can make money trading if the odds are like flipping a coin? Okay, I'm going to sell here, I'm going to buy here, and if odds are 50-50, how do you make money? Targets and bigger and stuff? There you go, Kenneth. Kenneth M. Perfect. You must have an edge. Now, I get to see some other very good answers coming in here. Risk management, true. Targets are bigger than your stops. Yes, Jim. Cut the losses and let the runners run. That's correct. Walter, cut the losers, go with the winners. That's true. So all of that is doing what? Skewing the odds in your favor. So we see big casinos. We've got huge casinos all over the world, really, right? Some of you might have been to casinos. Anybody here been to Vegas? Been to Vegas? Been to a casino? Well, they got casinos everywhere now. They're all over the place. You don't have to go to Vegas or the normal hot spots anymore. Tahoe. I know some of you have been to a casino. Well, how do these big casinos, how do they make billions of dollars? How do they make hundreds of millions of dollars? How do they afford this lavish decorations and all this money? How do they do that? How do they do that? How are they making money? The house edge. They cheat. Michael P. I don't know about cheating. By taking your money. That's exactly right. They serve free drinks. There you go. Repetitive human behavior. They have an edge. It's called the house edge. Kenneth hit it right on the head. It's the house edge. And guess how much it is? It's not very much. It depends on the actual game that you're playing, whether it's slots or, whatever, and I don't want to spend a lot of time talking about gambling, but it's a very, very small edge. Sometimes it's as low as 1% or less. So they have a 1% edge over you. Whoever is in there putting their money down, they have an edge. And so, but you take that small edge and you leverage over hundreds of billions of dollars, and that's how they make their money. Some games have a little bit more edge. Some I think it's as high as like 2, 3, even 4% edge. All right, so why are we talking about that? Why are we talking about edges? Why? How does that relate to what we're doing? Yeah, it's 1 to 3%. I thought it was Kevin. Yeah, 1 to 3% edge. That's all they have. That's not very much. Well, now how do we get an edge on our 50-50 pulling the trigger situation we're stuck with here? In order for us to compete in the financial markets and make money consistently, we need our edge. How do we get that edge? Viper is the edge? Okay, Viper training. Yeah, that's true. I think somebody typed it in a few minutes ago. Repetitive human behavior. So we need to train our eyes to look for where the highest opportunity percentage-wise is for us to enter trades. So let me get more specific and tell you exactly what I'm talking about here. And I'm going to use this trade as an example. We all agree we're in a downtrend. There's pretty much no question about that, which represents a series of lower highs and lower lows. Now, statistically speaking, there is a high probability that in a retracement, the market is probably going to come somewhere up into this area right here. Now, why did I draw a box? Why didn't I just put a line on here and say short it right there? Because think of it this way. When the algorithms, and most of the trading is done through, most everybody knows this, algorithms, computers, right? And there is, you know, a modicum, a handful of, there's several thousand actually, proprietary traders, discretionary traders, just like us, who are trading based on what we see visually on charts. And so what's happening is that each one of these thrusts, the computer is taking profits, right? So that's what's happening here, right? Here the computer got short, and the computer's going to take some profits. And all the traders, so that's profit taking. In a downtrend, you call it short covering. The short covering creates an updraft, an upward draft. Stand by 1 second, please. Testing audio. Can you hear me? Testing audio. 1, 2, 3. Testing audio. Can you hear me? Am I back? Hello? Yes. Oh, okay, good. I lost the mic for a minute. I don't know what happened there. Cut the mic off. Yeah, so just real quick. So what's happening here is that traders all over the world and the algorithms and the computers, what have you, they're shorting, right? They're shorting the market and they're taking profits. That's short covering. Upward draft. When they reach equilibrium, the market pauses, and then the selling begins again. Selling begins again down here. Then we get some profit taking. So the cycle repeats itself in a trend. That's what that is. So knowing this ahead of time, that markets are going to retrace based on profit taking from the shorts, we can estimate where we think that the market is going to go on profit taking from this thrust right here. Right? Here was the thrust. And so if there's going to be some amount of short covering and profit taking, we can anticipate it coming somewhere up into here. And I like to draw a range around the midband. Everybody says the midband. I know everybody loves the midband, and sometimes it comes right to it, and that's my favorite trade too, okay? But the fact of the matter is it can go a little deeper, and it can go a little more shallow with a shallow retrace. So it's healthy to think of that as an area. So when we're anticipating a trade with this area that we're envisioning in our mind's eye, what are we doing when we're doing this? In effect, what are we gaining from doing this anticipatory, looking forward, thinking area thing that we're doing here? What are we actually doing by doing that? Yes. You're getting your edge. right? You're looking ahead. You're anticipating where a market's going to go. You're thinking you're going to take a short on a rollover here, and you're trying to increase your odds of winning that trade much higher than 50-50, which everybody else might willy-nilly be buying and selling whenever it does whatever it does, because they don't have any indicators and there's no anticipation of what's going to happen. You are creating your edge. This is probably one of the most important things in all of your trading to learn, develop a skill set to do, is this part of it right here. So for instance, that's why you hear things in the room like this. You know, we just had that rollover trade on NASDAQ where we came off the mid-band here and rolled up there around that 33 area. We're already short. There's a couple of places to look for swings, and you might want to put tight stops at this swing right here, just above a close above 27 3/4. For a tight stop, looser stops would be up around 30 3/4 because I anticipate a rollover up there. So what I'm saying is that a looser stop might be sitting up here because I'm actually anticipating short covering to push the market back up towards this mid-band area, and you can either leave a looser stop because you're short all the way from over here and you want this to be one continuous trade, or you're looking to get into it because you already missed the thrust, and so we're looking for a pullback into here. We're trying to increase the odds of our success. And the anticipation part of looking forward is how you're going to do that. Now let's look at what happens. By the way, that's why I use two types of stops, the tight stops and the loose stops. So, okay, Walter, I know you got to take off. Have a good one. Some people have to leave. I'm going to wrap up here. I only got a few more minutes. So those of you with the tighter stops, you would have been taken out right here. Right? Somewhere right in there. Right? Do with the tighter stops. Let's see what's happening. What is this bar doing right here? These bars. What did this bar just do right there? Where my cursor is. What about this one? There's three. There's 1, 2, 3. How about now? I'll give you some more time to look at it. How about this one right here? How about that bar? Where are these bars located that are happening right here, these yellow bars? Where are the bars located right now on this retracement right here? Here's our short covering. It's right in the middle of the sweet spot where we were looking for a trade, isn't it? It's in the sweet zone. That's right, Richard C. It's right in the sweet spot. This is like if you're a baseball player, and you know you've seen softball and baseball games, and they have a pitching a strike zone, right? And the pitcher threw it right through a beautiful pitch right down the middle, right teed up real nice for you to just hit a home run. It's right in the middle of it. So what do? We use our tools. We can use the Object Trader Ray. We can use the line tool. We can box it in with the region box. All manner of ways to get into the trade. And we're looking for a rollover to get short. We anticipated where the market could have gone. The market comes right into our anticipated sweet spot zone. It's hitting its head at resistance and trying to roll. The trend is down. We're looking for shorts. And then the market comes up and it hits it. And then I'm trying to advance the stupid chart. For goodness sakes, it's driving me crazy tonight. Stand by 1 second, please. And then we roll over and we take the short and we go down to a fresh low. Does everybody see that? So we have to develop that skill set if we want to be successful, especially if you're going to trade trends. And not all markets are similar in this manner, in the fact that they go right to the midband perfectly. This was an exceptional day where it just hit the midband perfectly. I think there was like 6 trades here on the short side where it just handed you money. I mean, this is like textbook short setups. They don't get any better than this, really. I'm telling you, just one right after another. Any questions on that? I'm going to advance the chart to later in the morning, and I'm going to ask a question. 10 seconds on the clock because we're almost out of time. I'm going to just do a few more trades. This is later in the morning. This is coming up on 7 o'clock Pacific. This is yes, no question, 10 seconds. Is this a trend change, yes or no? Right over here. It's a trend change, yes or no? Trend is down. Is the trend still down there, yes or no? Simple question. A Y or an N? 6 seconds left. A Y or an N? So if you get up tomorrow morning and the instrument you're looking at does this, would you start buying the long side, or are you still shorting it? Simple question. Not complicated question. Yes or no? Is the trend change? Yes or no? And there is no maybe here. It is a yes or no, by the way. I'm not messing with you. 3 seconds left. Trend change, yes or no? Good. No. Time's up. This is not a trend change. How do we know? It could be transitioning. All right. Here's how we know. And I'm just going to make this as simple as possible. As simple. I'm not going to be. If it stays within the confines of the outermost bands, generally speaking, you might still be in a downtrend, or you might be going sideways. All right. So as far as we're concerned, at this point, we're still shorting the market. Now, it may turn out that it rolls down and hits the midband and bounces, or it may go down and check the lows. We don't know. But if it stays within the confines of these outermost bands, it's either still down or it's going sideways. Would we all agree with that? Let's see what happened here. Here it rolls over, takes out the midband, and goes down and almost checks the lows here. So that was a short, right? Right here. Okay, let me advance the chart a little bit more, and we'll see what happens. This is this morning on NASDAQ. Now, this would have been just slightly after 7 o'clock Pacific. Okay, here's another thrust. I'll ask it again. I'll only give you 5 seconds on this one. We're almost running out of time, so just don't do a couple more trades and we'll wrap. Okay, how about now? Is this a trend change? Here's the next thing that happened. This is almost 7:10. Now, you know, from my eye, we're getting a slightly higher low here, right? So that could be a trend change right here. See where it's hitting right this 24? So we get a higher low. We're getting some higher lows. That could be a trend change here happening right there. What do you think? Maybe we should start buying it. Maybe we should buy right here, perhaps. No. What was our rule? What was our simplest rule in the world? As long as it stays within those bands, you're either going sideways or it is trend continuation and you are still shorting the market. Yes? Good. This was a short. Rolls over, hits the midband, chop it around a little bit, went down, checks another swing, comes almost all the way down to check this low at 14.25. I remember these trades. I remember them. All right, last question and we're going to wrap. Ready? I'm going to make this one tough. I'm still here, David D. Hang tight. I'm going to pop two more things up, three quick things, and then we'll wrap up. These is really important. This is the final part of what I wanted to cover tonight. Okay, ready? Here we go. 5 seconds on the clock. Is this a trend change, yes or no, right here? Now you're at 7:25. You're almost at 7:30, right over here. Is that a trend change, yes or no? Right here. 5 seconds on the clock. You should just... I really want everybody to practice this every day in market replay, in the live room, with your own trading. I want you to do this exercise with yourself. Move charts back and forth. Advance it, pull it back. Advance it, pull it back. Train your eye to see this. Yes, this is a trend change. What was our rule? It stays in those bands. It's either going sideways or trend continuation. What did it do right here? Broke the top of the band. The background changes to green. The bars are blue. And the mid-band, and all the bands for that matter, which had been stuck in a sideways manner, background had turned to an opaque neutral color. You can always see that mid-band and all the bands going sideways, characteristic of a range. Yes? Albeit a lower range where we're still shorting, but now that's taken out, okay? Now we're starting to head up. We're looking for potential entries long since we're heading up, right? Here's the mid-band stair stepping up right here. Right here. There's the mid-band stair stepping up, coming out of that flat sideways type action, right? All right. Okay, here's the continuation from that last move that we just saw. I'm ready to buy right here. I've got my buy order ready. Looking to get filled here on this pullback. This you get this bar right here, 29 3/4. Gonna buy 5 seconds. You ready to buy here with me? Yes or no? 5 seconds. Anybody buying? Market order. 29 3/4. We're right here. Market's heading up. Trend has changed. Everybody agreed. Everybody said yes. So we're buying. 5 seconds. 4 seconds. You got to instantly know, right? Market doesn't sit around in real time and say, well, here, let me just kind of sit here for a couple of minutes while you think about what you're going to do. When you see stuff in real time, you got to know in a matter of seconds of what you're going to do. No, this is the thrust. We do not, what did he say, like less than 5 minutes into it 3 times. You do not buy or sell thrusts. No, 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 no. This is not the buy. Second part of the question for everybody who said no, which is perfect. Thank you. If the market retraces, which it has a high likelihood of doing, we're going to put that edge on our side, and we're going to look to get in this market where? I'll give you 15 seconds for that one. And then this is the last thing we're going to do. 15 seconds on the clock. If and when the market was to retrace from the swing up here at 31.50, where might it come to for us to buy and get long? I'll help you with that part of it. You know, we said it's an uptrend, so we're buying to get long, right? We're not shorting it, buying to get long. Where are you getting in? 12 seconds left on the clock. Where are you getting in? Remember, this is how we compete in financial markets. This is our edge. You know, not everybody has these tools. Not everybody's looking for it. You got a lot of scripts out there. You got a lot of people out there sort of willy-nilly getting in and out of markets. That's, you know, that's how they lose their money. You know, they're not looking at it with an intelligent approach and some forethought. Time's almost up. 9 seconds remaining. Where might you get in a retracement in this uptrend? Four seconds. Okay, time's up. All right, we get some great answers here. Wow, okay, good. Looks good. Jim W., Peter, Jimmy around the mid-band, Michael P., good. Adam, I see some ranges. Good. Carl, excellent. Yeah, so essentially what we're looking at is what we just get is we generally like to look around the mid-band. So our area might, pardon me, look something like this. So if you said anywhere from like 24 to 27, 28, anywhere sort of in here, you were spot on. Yeah, so here's our thrust. We're expecting a little bit of profit taking to occur, which will have a downward thrust on the market, and ideally pause in our little sweet spot area and giving us a chance to buy and get long. So let's watch what happens. She comes down, hits her head right there at 27 a little bit, comes down, and right here is where you got your dip into the sweet spot of the opportunity zone, right in here. And then let's see what she does. Comes up, gives you your scalper shot on your first contract. Here's your scalper shot right up to the swing. Pauses slightly there, and then just takes off like a bullet all the way up here. This was just a beautiful trade. This was just unbelievable, beautiful trade. This was your runner of the morning right here. A couple contracts on this thing would have put some serious coin in your pocket. That thing ran 80 ticks. This ran 80 ticks. Most of you know you don't get 80 tick runs walking down the street every day. All right, good. Any final questions before we wrap? This is a good session. Appreciate everybody coming. Stop the recorder now.